You make money when you buy a stock, not when you sell a stock. So don't buy an overpriced stock. How are you guys doing today? My name is Apple, and today we are filling in the financial gap between schools and the real world. And today what we're talking about is a price to book ratio, or otherwise called the price to equity ratio. And what the price to book ratio is it's a way to value a stock to be able to tell if a stock is overpriced or underpriced, so that you can make sure that you're not paying too much for a stock, so you're not buying a stock when it's up instead of buying a stock when it's down, and so you can find the stocks that are on sale to buy instead of buying the stocks that are overhyped or hot stocks right now. So that's what we're going to be talking about today. We're going to be talking about how you find it. We're going to be talking about what it means. We're going to be talking about how you can use it to find stocks that are undervalued and stocks that have good potential to grow over time and bring you some good returns. All right, so how do you find the price to book ratio of a stock? Besides just looking on the stocks like information page and finding out what it is, what does it actually mean? Let's figure out how to contextualize it, figure out what the numbers behind it actually mean. So what you're gonna do is you're gonna take the price per share, obviously. You're gonna take price and divide it by the book value per share. Makes sense, right? Price to book ratio, price to book ratio. All right, book value. That might be a term that you haven't heard before. What does book value mean? Well, what book value is it's sort of how many assets a company has, subtract out how many liabilities that company has, and you're left with the book value. So basically, how net positive or net negative are they in terms of assets? All right, so to calculate book value per share, what we're gonna do is we're gonna take the assets of a company, we're going to subtract out the liabilities of that company, and we're going to divide that by how many shares there are to calculate our book value per share. So let's write that out. We got assets minus liabilities divided by number of shares. And that's going to equal our price, or our book value per share. All right, so let's take a second to think about this right now. So if we're looking at our price, we're comparing it to our book value per share. What we're really comparing is how much you are paying in relation to how many assets this company actually owns. All right, so now let's look at the price to book ratio of the S&P 500 index and sort of how that has been moving over time, just to get a better idea of what a contextualized price to book ratio is going to look like. So right now we're looking at the S&P 500, and currently the average is about a 3.48 price to book ratio. So a 3.48, that's going to be average throughout the S&P 500, which again is the collection of some of the 500 biggest companies in the US. So S&P 500, good estimator of a general market. So we've got about a 3.5 for the S&P 500, and that has been steadily climbing since about March of 2009, when, as you'll recall, that Great Recession happened. So at the bottom of that, we were sitting at about, so in like 2009, we were sitting at about a 1.78 price to book ratio for the S&P 500, but it did start real strong in about 2000, at which point the average price to book ratio was sitting at about a 5, which is massive for a price to book ratio. For the average of the S&P 500 to be a 5 is massive, but after the dot-com bubble, after that popped, we fell in 2002 to about half of that. We were sitting at about a 2.5. So as you can see, the price to book ratio for the S&P 500 really fluctuates with market trends, with large scale market trends. Like with the dot-com bubble, we were at a 5, we dropped down to a 2.5, which is massive because looking back at that formula, either the prices were doubly inflated compared to the assets of the company, or the assets fell dramatically. So as you can see, these numbers are going to change with large market fluctuations. All right, so now let's dig a little deeper. Let's look at a specific industry and see what a price to book ratio looks like in a specific industry, because as you guys will remember, what you want to do when you're looking at metrics, when you're looking at indicators for stocks, is you want to compare first to the large scale trend of, say, the S&P 500 compared to that average of about a 3.5. Then you want to compare a price to book ratio of a stock to other stocks in that industry to see where it stacks up with its competitors, with other people in that industry, to see if they are sort of overvalued in their industry, undervalued in their industry, because again, price to book ratio is going to fluctuate pretty heavily based on what industry you're in. So if you're in the utilities, you're gonna have a very different price to book ratio than if you are in a technology company, than if you are in a real estate company. So with all of these different industries, there are going to be different standard price to book ratios. So that's what we're gonna look at now. We're gonna look at the broadcasting industry. So we're gonna move from the S&P 500 over to broadcasting for a second. And we'll just switch colors here just to make it a little easier to see. I'm gonna say broadcasting. And the players that we're gonna look at are Disney and Viacom. So everybody knows Disney. Disney is, again, they make the Disney movies, they got the Disney Channel, they got Disney Radio, they got all that good stuff. So we're gonna look at Disney, and their current price is sitting at, as of me filming this video, sitting at about a 108.97. Over their book value per share currently is at about $26.77. So divided by $26.77. So here's our formula again for price to book ratio. We've got the price of a share compared to the book value per share. So if we do the math on that, we're going to come out to about 4.06 as our price to book ratio for Disney. And I'll just show you guys where I got that 26.77 number as well. So if we take our 26.77 is equal to, remember, it's the net assets, so the assets minus the liabilities divided by the total amount of shares outstanding. So with Disney, we have got about 40.32 billion assets divided by 1.502 billion shares outstanding. So with Disney, that's where we got that 26.77 number, which ends up right there. That's our book value per share, and that's how we get our price to book ratio of 4.06. Perfect. Now let's take a look at Viacom. And again, Disney's ticker symbol, that's going to be a DIS. Viacom is a VIAB. So the price of Viacom right now is sitting at about a $32.20. And let's find our book value per share for Viacom right now. All right, so the net assets of Viacom are worth about $6.03 billion divided by their shares outstanding, which is about 402 million shares. We're gonna end up with about $15. So we've got about $15 book value per share for Viacom. Gonna plug that in right here. $15, and that is going to come out to our total of a 2.15 price to book ratio for Viacom. So as you can see, Disney price to book ratio of a 4.06, Viacom 2.15. So we've got some pretty drastically different price to book ratios within the same industry of broadcasting, and the industry average for broadcasting is actually a 3.2. So as you can see, Viacom falls pretty significantly below the average with a 2.15, and Disney is sitting pretty significantly above the average at a 4.06. So if you were just using this metric, you would come up with the solution that Disney is a more overvalued company than Viacom due to their price to book ratio, and in comparison to the price to book ratio of the broadcasting industry, and in comparison to the 3.5 price to book ratio of the S&P 500 index in general. So this is a pretty valuable conclusion. However, it is more important to use the price to book ratio in more asset intensive industries, such as like utilities, where the business is very focused on the assets held by that industry. Whereas with broadcasting, still partially asset intensive, but not as much as an industry like utilities. So when using this ratio, it's important to take it in context with a bunch of other indicators, but it is still very important in valuing an investment in whether it is overvalued or undervalued. So now let's look at what it means. Well, like we said, it's a general way of evaluating whether a stock is overvalued or undervalued relative to something else, such as the S&P 500 or the industry that they're in or a competitor. So it's not sort of a standalone number that says, okay, if it's over this number, it's overvalued. If it's under this number, it's undervalued. That's not how it works. You have to compare it to some sort of context, some sort of industry or market or competitor or something. There has to be some kind of comparison there, and the more similar the things are that you're comparing, the better result you're going to get, because you don't want to be comparing apples to oranges. You want to be comparing things that are similar in as many ways as possible. And again, you're comparing the price of a share to the book value or the assets recognized by that share. So you're getting a sense of how much you have to pay for the assets that this company contains and how much of a gap there is in between these numbers. So if you have a very high price to book ratio, you have to be aware of what you are paying that extra money for, because you're not just investing in the physical assets of a company. There might be some intellectual property or patents or something that is driving that price to book ratio to be higher that is not recognized by just the simple balance sheet of a company. So you want to be aware of that, and you just want to sort of know, okay, I'm paying this extra gap for X, Y, and Z because I think this company has some serious potential here. But yeah. And if you remember from the book Rich Dad Poor Dad or any other place, assets is just what brings you cash flow, what puts cash in your pocket. So what you are paying for the cash producing things that a company owns is what the price to book ratio sort of symbolizes. And it's sort of a brief snapshot into the balance sheet. Again, here's a little balance sheet for you guys. We've got our assets, liabilities, take those. Here's our balance sheet. And between this, the price to book ratio is sort of giving you a snapshot into their balance sheet if they are net positive or negative on their assets and how much you have to pay for exposure to those underlying assets. So it's a great tool for long-term value investors because it's able to, again, get a glimpse into the balance sheet, which is very important for long-term value investors. You want to make sure that your company has solid fundamentals before you invest in them, because you don't want to be investing in a company that is full of liabilities, has no assets, and is really just trading on optimism and speculation for the future as a long-term value investor. All right, so how can you use a price to book ratio? Again, we talked about how it varies by sector, by market conditions. If you are in, again, the top of the .com bubble, you've got a very high price to book ratio. If you are at the bottom of that bubble, then you've got a very low price to book ratio, stuff like that. A low price to book can indicate that a stock is undervalued, but low is definitely relative to something else. You have to have that comparison there. You can't just set a number, and if it's below that, then it's a good buy, and if it's above that, then it's overvalued. That's not going to be very valuable in your investing. But if it is above the market average, if it's above the industry average, and if it's above its competitors, then you might be looking at a hot stock that is just trading on a lot of speculation, and you might want to give it some time to cool down and get in when it is a more on sale or a good buy. And this is just a really good metric for thinking about how much you're actually paying for the underlying assets of a company and getting a brief glimpse into their balance sheet, which you should definitely be taking a closer look at when you are considering a long-term value investment, which is what a price to book ratio is great at evaluating. Anyways, that about wraps it up for the video, guys. That was the price to book ratio. I hope that was helpful for you guys. I hope you learned something about the price to book ratio as a indicator for your potential investments. If you did, please leave a like and subscribe to the channel. Let me know in the comments below what other indicators you want to see videos about. I did one on price to earnings ratio, so definitely check that out. And share this video with a friend who is also starting to get into investing, is a seasoned investor, whatever. Just send them this video, let them learn about this indicator, price to book ratio. It's a pretty valuable one. I use it a lot when I'm evaluating my long-term investments. So I will see you guys tomorrow, and until next time.